Hello and welcome to the closing beat, everybody. Happy Monday to you. How you doing out there? All is good? Welcome, welcome. We are financial advisors here at Jazz Wealth. While other advisors are playing checkers, we're playing chess in the form of every dollar counts. You know what I mean? The good and bad debt, that all means something now. No, for 10 years, it didn't mean anything. Tax strategies, you can't overlook them. Who can you trust to comb through all that information that's not going to try to sell you something, whether it's us or somebody else? You got to find them, man. There's too much out there with the new tax laws and everything. All the different cool little games we can play. And our Wine and Wealth on Thursday nights has been really focused on that, where we're just kind of breaking down wealth, breaking down all the different strategies that you can use to, sort of cast a wide net and then individually go help clients there. So hope you'll check it out. I won't be long-winded with you here today. I will tell you that apparently I found out there's no Guess the Dow winner. Because you all guessed above where the market was. I don't think we've ever had that. Has that ever happened, Cody?
I think just during COVID. And actually, we have a special thing if you want to flip to the Cody page. But yeah, I think COVID maybe during the really rough week there. I think that would have been the only time. But we got a whammy, right? Is that how that works?
Oh, that's true. Yeah, that's how that works. Official whammy there. Nobody guessed. Everybody went over there. So, hey, feel free to play. jazzwealth.com/guess the Dow if you want to play. It's a $100 gift card. Sadly, we were all guessing too high there. Well, the reason for that is last week, every index, no matter what you look at, every index fell over 2% there. This is the S&P we're showing on the screen here. Remember, Mondays have been strong, save last Monday. Mondays have been the strongest day of the year. Last Monday was the only day we hadn't really seen that there. And so the S&P finds itself closing in correction territory. That just means 10% off of this high here. Friday would be the official start of that correction there. This correction took a total of 65 days. The median over the last 7 years, by the way, if you're curious, is 32 days. So this correction took longer than the median correction, 10% pullback, over the last 70 years there. Now, is a correction a good thing or a bad thing? Is this time different? Oh, boy, this time, boy, I'll tell you what. There's literally, as of this last one here on Friday, there have been 103 corrections since the start of the S&P 500, since day one. Right? You start the clock there, 1928, go all the way through. 103. So these are not odds, right? Just over one correction a year, basically, is what you get there. So I'll ask you, is this time different? Was the time before different? I would argue 3 times ago you might have said, yeah, this is a little bit different, right? None of them have been different. Every correction has regained itself, right? And over that time there. So imagine if you bought every correction instead of running or being nervous or, whatever you got going through your head this time, saying this time is different. The rest of them mean nothing, but this is the one. I mean, statistically, there has to be one at some point, right? I mean, that's probably the way it's got to go there. I would like to point out something fun here. The S&P, how do you think it performs after a correction? Just to either make you really nervous or get you excited here, depending on what the data shows, huh? How do you think it performs? Does it outperform itself? And that's the way I like to do it. I like to say the S&P does X over its lifetime, right? So if we're going to mark every year, what's the average for the year? 3-month window, what does the S&P normally do? And then say, well, when something happens, does the S&P tend to do better than its average, or does it underperform? Is it worse? Well, you can actually look and see. Over the last 70 years here, what we've done is we've looked at the performance of the S&P over a given 1-year period. So if you go back to 1952, which to save us some time, the reason that was chosen, if you're not familiar, the S&P or the stock market was not always open 5 days a week. So anytime you run data and you're going to go try to pick on something, there's always a little hiccup right there at 1952 because that's the first time that we went to a 5-day trading week. So people that share data that are like over the lifetime of the S&P, it's always a little off unless they tell you that that's what they did. We do it every time. Anyways, So in the last 70 years, average 1-year performance for the stock market, 8.93%, about average there for the whole life of the market. And then if you look over 5 years, the average return per year, 7.45%. Well, when there's a 10% correction, the S&P tends to outperform itself. So remember how they say you can't beat the S&P? In this window, you beat the S&P by investing in the S&P, right? It just outperforms itself on average when there's a correction. So after a 10% pullback there, the S&P averages a 10.61% gain versus what it normally does over any 1-year period. Same over the 5 years, just ever so slightly outperforming itself there. So I wanted to just kind of point that out. Oh, one other thing I want to point out. Here we are. This is October. I'll use the futures, so it's going to be a little bit off. So about the high of October was here, and so far the low of October right there, 6.94%. In other words, we would say the range for October has been 6.94%. It's awfully close to 7.1, isn't it? The stock market pulling back here in October, or I should say having this range, I guess, it could technically bounce the rest of the month. There's only 1 day left, but the range from high to low, talked about this before the month started. It is the widest range on average if we rank them by month. In other words, October, for whatever reason, has a big difference between its highs and lows for the year, or for the month. What happened here? It has a big difference between the high and the low, but not more than the average just yet. There's always a chance tomorrow, of course. So what's happened is this pullback, this movement in October is perfectly normal. There's nothing odd about it. Maybe the fact that it's down a little bit, but there's nothing odd about the market's movements. So if you're nervous with your 401k or whatever, I don't know what you have. All you have is media talking points, which means you're investing emotionally, right? So we got to take that out. So I just thought that'd be fun to point out that, hey, 6.9, almost 7% of a range here on the S&P futures, that's average. That's nothing we really would get too carried away with, right? Very, very cool. So I love when I could share data ahead of time, then come back and go, look, it's either odd or it's not. And if it's odd, we want to know why. And if it's not, you go, business as usual. Okay, great. Let's use it as an opportunity instead of being all nervous and stuff. The NASDAQ officially fighting off a correction here today as well. It's just a little bit different type of correction there. It is the only index that still has double-digit gains year to date. In fact, 30%. So very nice year-to-date gains there. So that's the NASDAQ there and still working on pulling back. We'll see. The Dow, I give up. I don't know. The Dow just, I haven't had any good feel for the Dow. Thankfully, we don't base anything off of this, but I don't know what to say there. I just kind of give up on that one. Sector-wise, in the S&P, energy was the worst last week. Big pullback there, 6% pullback there. It puts it negative year to date, by the way, as of Friday. So that's one of the sectors that has done that. I do want to point out healthcare had the sharpest of pullbacks, not the biggest there, but down 4% last week. It's officially down 8% since its peak there. There are only 3 sectors positive year to date. How can that be? That's weird. Wait a minute. There are 11 sectors in the S&P. Only 3 of them are positive, yet the S&P is still up, what, 9 double-digit? 9% year to date? 10%? So, wait, the rest of them are down year to date, but there's only 3 that are up. 3 and 11, it's not more than half. How can that work? Remember, the S&P is weighted by size of your company, right? So Microsoft is bigger than American Airlines. You get what I'm saying? So I want to point this out here. We have, you could probably guess the tech sector, one of them that's positive year to date. Communication services, pretty clear, looks that way as well. And consumer discretionary, still positive year to date. Well, how is that possible? Let's take a look here. Those 3 sectors make up 47% of the S&P. So yes, As of the most recent October weightings here, technology, consumer discretionary, and communication services basically add up to 47%. Let's just call it half. So half of the weighting, or the voting rights, if you will, come from those three sectors. So as long as they're holding up, then it's fine, right? If those decide to continue to fall, you could very quickly see how 50% of the S&P is in trouble. And all you have to do is look at three individual sectors there. I think it's very, very cool. Add to that, we have some real decisions to make. Now, I would not be as in tune with this if I did not do what I do on a daily basis. Money market funds, money market accounts, bonds, CDs, all present a rather attractive opportunity. Maybe bonds being the most interesting, right? So if you were an investor in your 50s, 60s, 70s, whatever, and you come to Jazz Wealth and you say, let's look at my dollars. Where should they go? How should they do things, right? Well, inevitably, we're going to find that some money needs to be safe. Now, times that by the millions of people all over that invest in the U.S. stock markets, but U.S. people that invest in the stock markets, they have that general long-term focus there, right? If you look at that and say, well, normally I would take 30% of my money. I might be a little bit safe with this money. Previously, I had nowhere to put the money. But doesn't bonds seem kind of attractive now? When you weigh the risk, if I have to talk about risk instead of returns with you, is there a greater risk of the stock market falling more from here or bonds falling more? Keep in mind, bonds are down about 50%. 50, down 50%. So something that's fallen 50% or something that is just kind of starting falling and is just about 10% off of its high there. Where's the risk? So more and more people are saying, oh, I just don't think the Fed's going to be raising rates a whole lot more from here, which maybe there's not as much pressure on bonds, and bonds have overpriced the fact that Feds are going to raise rates to a point that they haven't even raised them to yet. So the risk from the astute investor is saying, I don't think I'm going to go with the bond market. You know, I might put a little extra there for the moment, get the higher yield and the severe discount at the moment. So now, where was that money coming from? It was in the stock market. We've been saying that for so long here. Money comes out of the stock market, not necessarily because people are fearful or were fearful, but because there's a higher return for what is perceived to be smaller risk. I can't say officially that it is. I'm just saying, you know, that's the mentality. And I see it from people constantly. So keep that in mind. All right, this week, let's do the rest of them here. The Russell, right? We talk about that. Really seems like making a beeline for the 20% pullback there. Bonds pulling back here as well today, but ever so slightly. Chopping around short-term, long-term, go wherever you want on the curve. You're basically seeing the same price action in the bond market, so it's not the most sexy to talk about right now. You've got oil pulling back here as well. That's going to continue to hurt on energy. Remember, energy is going through a bit of a transition. They're in M&A mode and return cash to shareholder type mode over there. So it's good if you like buying discounts and want that sort of return of your cash there. Elsewhere, what we have is Apple and 149 other S&P names will be reporting earnings. You got McDonald's, Anheuser-Busch, AMD, Caterpillar, Airbnb, Starbucks. I'd just throw a name out there. You probably will guess one that's reporting this week here. And that'll be the focus, but also the Fed. Tuesday, Wednesday starts their meeting there. The refunding of the Treasury is kind of a separate thing and sort of old news, but the Fed will get the attention on Wednesday when they make their decision. Are they going to raise rates or are they going to lower rates? Did you know that actually nobody is betting on the Fed to raise rates? Really, really kind of interesting here. So we have this is not my stat, this is directly from the Fed. There's people betting that there's a 98.2% chance they leave rates the same. The current rate range is 5.25 to 5.5. They're projecting there's a 98.2% chance that they leave rates at 5.25 to 5.5. So if you've never read the chart before, that's how it works. Notice off to the right, which is where you would see if they were going to go 5.5 to 5.75 or something crazy. There's nothing. There's just nobody making a bet. No one is betting they're going to raise rates. What I find fascinating is the other people that are making bets, they're betting on a cut in rates. So technically, there's a very minuscule chance, but a chance that they could cut rates. I don't see that happening. I think that's just kind of people saying, well, we're reaching that point where at some meeting here, we're going to start thinking about cutting rates. So it kind of signifies that people betting in the Fed futures market here are saying that the rate hikes are over. For the moment, people believe that's it. This is the top of our range. I don't know. We'll see. And that, that all comes from the comments the Fed's been making prior to this, what now is called a blackout period, about saying, the bond market's doing our work for us. Basically, they're saying rates are high enough, and we didn't even have to do some of the work at the tail end of this rate hike here. So pretty cool there, I think, to see things like that. Last thing I'd like to point out before we do some stocks in the news. I'm sorry, I told you I wouldn't ramble a whole lot here. Okay. Clean energy ETFs have officially given back all of their after COVID, yay, Inflation Reduction Act. Wait, no, it's green energy stuff. All that money that came out and is coming out. Is this a discount or is this crazy? Is this just nonsense, right? A lot of bad news in that clean energy space, that sort of green space right now. You've got iClean down about 60%. You can look at any of them that you like. Invesco here, their TAN ETF for solar is very popular. That's down 65%. You want to go to wind energy. It's an easy ticker symbol to remember. FAN, down 48%. All of them giving back their post-COVID rallies there. You know what I mean? That's a tough one. So if you happen to have SolarEdge or Enphase and it's going bad, yeah, well, there you go. Everybody's doing bad. Okay, let's talk about some of the stocks in the news, then I'll take your questions. If you have any questions, see what I could do there, and then I'll wrap it up. Apple reports earnings here this week. Bloomberg was bold enough to come out and say, we think we know something. We think that the iPhone sales in China are starting to lag a little bit. Their actual words were something else. I just can't remember them off the top of my head. The good news is we'll see. Right? They're going to report their earnings. So either Bloomberg is right or they're wrong. Western Digital is going to break up into a couple different companies here. I think that's actually good news if you look into the details of how they're planning on doing that, but that's why they're in the news today. McDonald's gets about a 2% rally on the day. Earnings beat, but remember headlines. I could tell you, what's the headline? Better than expected earnings on stronger revenues. No real guidance given. Okay, well, that's the headline. How'd they do it? They told you. McDonald's actually, in their transcripts, they told you exactly themselves. The whole entire beat was due to them raising prices. And their wording was, comparable sales results benefited from strong average check growth driven by strategic menu price increases. That's fancy language for saying the average ticket amount, the receipt when it prints out and you take it with you, well, the average was higher than normal. And we can't figure out why it's higher. Oh, wait a minute, we raised our prices. So therefore, sales were a little bit higher. I'll give them that. Sales a little bit higher, but the average ticket cost was higher. Well, that's all you needed. That's good. That means you beat. You were able to raise prices and people didn't care. They just said, let's do this. Meta, I don't know how I feel about this just yet, but Meta is going to be doing, they call them, what is it? Ad-free or something in Europe and somewhere else too, where for about $11 US, you can pay to use Facebook without any ads. And they're doing it because, well, we have to accommodate this law. They've been picking on us for this, and so we have to have this as an option. I don't know. I'm not entirely sure about that one. I think it's clever, but I don't know exactly how I feel about that one just yet, because it's coming. Like, you're going to have to pay to use these things. They got you right where they want you. Broadcom says, so they are in the process of closing their deal with VMworks. And they basically just said that's ahead of schedule. It didn't really move the stock here today, but I thought that'd be interesting to share with you. Our Wine and Wealth this week, if all goes to plan, we're going to be bringing in a good friend of mine who happens to be in the financial services / insurance world. And I said, hey, I want my clients to be able to ask questions, but I don't want any sales. I just want you to answer the questions, right? Just honest answer, whatever it is. And he is a rather candid individual. So if he believes something is BS, he's just going to say it and then be able to tell you specifically why. So we're going to get to the bottom of all the insurance questions that people have, or maybe some of the things you see online. And we go, is that for real? And if so, what does it cost me? Is it a joke? So we're going to hopefully get him on with us there. I did pretty good. I saw Dave Chappelle last night, so I was really worried, guys. You know what I mean? Like just spitting out some of his jokes or saying some of the things he says. But I thought I did good, right? I held it on. Okay, well, now that I got to do that, let me hit you with some stuff. No, I'm just kidding. Yeah, it was cool. It was a good time there, but fascinating. individual. Okay, let's see what questions you have there. And in the meantime, while I'm doing that and getting that ready, we have a slew of earnings, you know, right? We talked about Caterpillar already. Global Payments is going to report there. Pfizer, AMD I mentioned. First Solar is a good way to see into that kind of green space to see what's going on there. Franklin Templeton, Amgen, all kinds of different names. So if you own individual stocks, yeah, you might want to pay attention just a little bit there. Yeah. McDonald's prices are ridiculous, he says. Okay. I haven't been. I sort of have had a weird, odd, like hankering for a sausage McMuffin with no egg. Sometimes I go with the egg, sometimes I don't. But I just, it's like hitting me more and more, but I haven't been, so I guess I can't say. But we know now for a fact that's what they did. Yeah. We read through SoFi's earning today. No, I didn't. I read through like 70 different things. I did not get to them. I know you pay closer attention to them, so I will, but I have not. So I can't give you anything specifically there. Sorry about that. Airlines in particular, so the question's on United, but airlines in particular selling off here. Rather interesting. I would agree on that one there. Tesla's kind of fallen into that trap as well. You know, they're sort of the last to fall into it, but the argument of, do we really need all this battery-powered stuff? This is getting a little bit weird. And then Panasonic is what really drove them today. Panasonic saying, we're just not going to make as much of our batteries, right? They don't use them for all their cars, but we're just not going to make as much because there's just not that many people. Still a lot of people asking, but not as much as we kind of projected. So maybe we'll just dial it back. Well, who's that trickle down to? You said, well, if they're not getting demand from their customers, who are their customers? Well, Tesla is one of their customers. Yeah. Fast Eddie says, are you due for tires soon? Why, are they expensive? I imagine. I can imagine. Your bank just gave you a HELOC, negative 0.05 to prime. Good for you. La-di-da. Oh. What'd you do for that? Did you wear a costume? Put on the old dog and pony show? Oh, man. What's it cost to charge the thing every night? Oh, yeah, I don't mean to, start that. I'm just saying that's, kind of what's going on out there. That's the answer to the Tesla question there. So that's that part. The UAW talking about going after Tesla as well. Yeah, they tried in the past. I don't know. I don't know how that goes. Put off a pretty good fight there. REITs, yeah, a lot of M&A going on in REITs. They're doing the same thing. They're like, we're just not going to even bother with our share buybacks here. We realize that things are going to cost us more. Our rates are adjusting. We need to keep our business going, doing what we do. So it's just cheaper to buy other companies that have assets that are leveraged at a lower rate than to go out and buy a new asset and have higher leverage. So you're seeing a lot of that, Doctor. Yeah, I can't blame them. They probably think the same thing. Yeah. You guys don't like your battery stuff, huh? Do the battery cars have problems there? I don't know. I have a battery-powered drill and a battery-powered weed whacker. They work. It does what it needs to do. You use it all that much. Thoughts on the Fed decision, up, down, or hold? I'm going to say, or they'll call it, a hold or a skip or a pass or a pause, or I don't care what word they use, but I think that's what's going to happen. And you got to go with the odds on that one. I don't know anything more than what these people probably do. So I just thought it was fascinating that they were planning a cut, or people were betting on a cut, not planning a cut. People were betting on a cut there. Yeah. PayPal buyback should be helpful to them. That would be my projection anyways there. I'll maintain my same comments, though. How do we can find news that gets us leaning one way or the other. Politics is a great example. Is it now, right now? Is that the time you want to take your shot? From just a technical level. Tom, do you think the rally in SP bear market rally is going to go back to October lows? No, I don't think so. You kind of got the ground invasion thing sort of out of the way there. You could make it sound scarier than what's maybe happening now, but I think that was part of what people were looking for. Besides the Fed and the earnings as they all come out, we just move right back to government shutdown. I don't know how I sort of feel about that. But from a market standpoint, you have now this extended market that's fallen. It did it. It made the 10% pullback there. There are algorithms, people, funds, retirement fund, everything that says this is good. And remember, the reason why you might find more support there, because basically everything is discounted besides those three sectors, right? So you can find ideas in energy and healthcare and now industrials. You can start looking through and finding that stuff. And so I think when people start going shopping for the end of the year here, that helps. Got to help. I hope it helps. We'll see. I hope you learned something here today. We've got a lot of cool stats that we shared with you, and kind of following up with some of the stats from before. We'll continue to do that for the rest of the week with probably a focus on earnings, because that's what's going on. So you guys enjoy the rest of your day or evening, and thank you so much for watching there. Have a great rest of your day.